Good morning, everybody. It's another day in paradise and go Knights go. Did you see that game last night? Oh my gosh, it was so exciting. It was a nail biter down to the end. And now we are going to the next seed, depending on who wins. I think they're playing tonight or maybe, I don't know, Seattle and I think it's Texas. I forget, the Krakens from Seattle. I know that. Anyway, it's all so exciting. And Vegas is selling 101 homes a day. We hit the 3-digit mark. Yes, that's fantastic. And turn off this phone. There we go. Anyway, we listed 60 homes over the weekend. Sorry about that. We closed 146 homes on Friday, which is awesome. And we have 51 days of inventory, and that's based on 91 per day. So it's probably a little less if we're selling 101 a day, but I go by the previous month. Anyway, last year we were selling 132 a day. Okay, fine. So it was a little more robust last year. The interest rates were lower. But anyway, it's all good. And investors are still, well, actually, investors have kind of gone down because of the interest rates. They're doing 25% of the market. They were doing up to 33% last year when the interest rates were like, it's free money, right? 3%. The other thing we need to know is that the median price is $430,000 and under. That's 25% of the market as well. And we listed 12 over the weekend of that price range, and we have 856 available homes, 430 and under. And these are single families. So of the 3,429 single family homes, we have 856 of them, which is 25% of them on the market. So all good. The rest of the country is having their challenges with inventory and listings. However, what I've done here for you is done your month-to-date sales comparison all on just a single sheet. I've done the $1 million stats, which I failed to mention. 3.5. We finally hit the 3.5 mark. We've sold $455 million plus homes this year so far, which is awesome. We have 768 on the market, and at 3 a day. That's a fantastic number. And the 768 is 16% of the market. So we have a very diverse market, which is really good. Really good. Let's see, daily recap. This is what we went over earlier. And there we go. And I will post all of these on the group. And we are in the process of, hopefully this week, we'll have our email ready to go. Kane is working on that, and I think he's just about ready to hit the button this week. So that means that once you sign up for the email newsletter, you'll get these automatically, and you won't have to go and download them. All right. Today, we are going to talk about tax strategies. And, of course, I'm going to play my favorite gal here, Glennda. And whoops, Glennda, that's not Glennda, that's Tom. Here's Glennda. Anyway, she's going to give us a little intro to our show today on tax strategies. So hit it, Glennda.
I wish I had bought when I was younger. I wish that I had bought sooner than I bought. I wish that I had held on to everything that I had bought. You are never, ever going to convince me that real estate is a bad investment. As long as you never put yourself in a position to have to sell, you will always be able to sell for more than you paid. You will have the luxury to sell when the market is up, and you will always make money. I wish I had.
So that's our, I'm going to play it again and mute myself.
I wish I had bought when I was younger. I wish that I had bought sooner than I bought. I wish that I had held on to everything that I had bought. You are never, ever going to convince me that real estate is a bad investment. As long as you never put yourself in a position to have to sell, you will always be able to sell for more than you paid. You will have the luxury to sell when the market is up, and you will always make money.
So that's kind of the segue to the tax advice we're going to get. And this particular CPA happens to be from Las Vegas, and Tom Ferry's interviewing him. And we are going to watch the first part of it today. And I will advise you where to go to see the rest of it if you want to hear the rest of the story. So here we go today, and I will hit it. And just so you know, in the last 3 years, if you had bought real estate, even though the market went down, you still would have 11% appreciation. It was 18% before the market took a little dip, but you're still making money if you bought it within the last 3 years. And
let's go right to the top. Like what should my listener be doing to lower their taxes and save more money? And I'm taking notes, so let's go.
Well, let's do the quick step back, because there's 3 types of incomes that are out there. There's the 10,000 foot view. There's active income. There's portfolio income, and there's passive income. People always conflate them together. Here's the easiest way to think about that. I don't know if you went to Catholic school, Tom, but I did. And if you misbehaved, you got a little whack, right? Maybe it was an eraser, maybe it was a ruler. But you learn pretty quick that you didn't like the whacks. Well, the tax code's no different. The tax code is giving you a whack every time you make an earned dollar. If you just let it hit you, it's literally going to hit you. The number one tax revenue source in the United States, when you actually break it down, you can go look at the IRS data, you can see how our Treasury makes money. Number one this last year was just barely income taxes. Number two, and sometimes is number one, is employment taxes. We always forget about old age, death, and survivors, or disability and survivors and Medicare. And that absolutely will devastate you if you don't put the brakes on it. And so there's a little bit of an issue I always get where people are saying, hey, the poor don't pay their fair share in taxes. They're not paying income taxes. I worked at McDonald's. I was making $4.15 an hour, and I was getting hit with employment tax on every dollar. Yep. If you do not put an end to that, it will absolutely tear you apart. It's 15.3%. There's a phase out on a portion of it, and then there's an add back on a portion of it. So I don't care who you are. There's a way to minimize that, and just recognizing that is the whack of the income. Like you're getting a hit. And then you look at the other types of income sources. There's portfolio, which is capital gains and dividends. You're looking at interest, you're looking at royalties. And it is not subject to, none of those are subject to that little whack. None of those are subject to the employment taxes. And then there's the passive income. And the one that stands out is real estate. Rental real estate is considered a passive activity. The reason this is important is because it is treated like no other investment activity. If I go and I buy a bunch of shares in Microsoft, and I buy $10,000 worth of shares in Microsoft, I get no deduction. No. I don't get to write any of that off. I don't get to, hey, you know what, Microsoft's going to be decreasing value over time. In real estate, I do. In real estate, I can spend $10,000 and probably generate, if I leverage it, I could generate a $10,000 deduction. And people are like, what? Yeah. They're literally giving you tax-free money if you want to take it. And it's just recognizing it, that's how our tax code is. And once you do, I'll tell you that the wealthiest clients we have, they're always saying, how do I minimize? How do I minimize? How do I minimize? It's not, what do I owe? It's, how do I minimize it? How do I minimize the hit? Yeah. And for your real estate agents, here's what you do. You do not operate as an individual. You do not operate as a sole proprietor. You operate as an S Corp or an LLC, taxed as an S Corp, depending on your state and depending on your real estate board. And if your real estate board doesn't recognize it and says, no, you can't, yes, you can. There's a way to do it from a tax standpoint, even if your real estate board says you can't. And that is real simple. There's actually case law on it. Is you make sure that you are letting your broker be aware that even though they're paying you as an individual, you're under the complete control of an S Corp or an LLC, taxed as an S Corp, and you deposit those funds in there. You make sure that they're aware. You get an employment agreement with that organization that you set up. It's between yourself and yourself. It's between your S Corp and you make sure those funds go in there, and it will minimize those employment taxes. And if all we did is we looked at somebody who's making $100,000 a year, and if all we did was get that money from you individually to you as an organization, it's gonna save you $9,000-$10,000 a year. Boom, immediately.
Is there any downside of not having the employment tax? We're not talking about like my future retirement at 62, 65, 70, that stuff.
So this is a misnomer. The way that Social Security works is it's front end loaded. So it's just, are you participating in the system? And we're not saying do not participate in it. We're saying minimize it. And legally, the way to do it, like if you have an S corp, is you're going to pay a salary to yourself. You're going to pay employment taxes, but you're going to pay about a third of what you normally would. Right. And that third of what you normally would is going to qualify you for the benefits and pretty much max you out anyway. Right. The rest of it is just a tip. You're just leaving a tip to the government. You're saying, hey, here's some free money. There's no reason for you to do it. And I know there's accountants out there. I know that there's people that have heard this. They're going to say the S corp is more difficult. No, it's not. It's the same rules, books and records, whether you're a sole proprietor or not. What I can tell you though is that sole proprietors get audited about 800% more than an S corp. It was 0.2% for someone making 100 grand as an S corp. It's what, 1.6% if you're a sole proprietor according to the last year's data. And they lose their audits a ridiculous amount of the time. It's actually about 94% of the time the sole proprietors lose their audit because they do not get the same preferential tax treatment as businesses do, as an organized business, as a corporation under the tax code. If somebody wants to go to loggerheads with me, I welcome it any day, because facts are facts. They don't care about my feelings, your feelings, or anybody's feelings. They are what they are. You get audited more, you lose. About 70% of the businesses out there are still operating as sole proprietors. The IRS knows it. They target, they win. It's easy. They go after a corporation, different animal. You got accountable plans. You can just show any business use on a deduction. You get to write the whole thing off, like your cell phone, your administrative office in your house. You don't have depreciation, recapture, all these nasty things you always hear about. You get so many more benefits just by simply saying, hey, you know what? I'm going to make myself into a business so the IRS knows what I am. Everybody else knows what I am. If I am a business and it says Inc. at the end of my name or LLC at the end of my name, everybody knows what they're dealing with when they're dealing with you. When you don't, then the IRS never really knows whether you're individually acting or as a business, and you have to prove that you're acting as a business, and that's where everybody falls short.
Give me the stat one more time on, so people that don't have an LLC or an S Corp or a C Corp, which we both would say they shouldn't have unless they were going public or something. So what percentage of them get audited versus the corporations?
Yeah, this is crazy. So you could actually go look up the rule. The last year, the IRS published the minutia data. It was table 17B of publication 55. It's the IRS data book that they put out every year. They didn't have it for 2020, for the tax year 2021, since we're in tax year 2022 right now. Hopefully they bring it back. But when you look at an individual with a Schedule C, which is the sole proprietorship, if they're making right around the $100,000 mark, I think it was 1.4, a little bit above that was 1.6%. When you look at all of the S Corps out there, it was 0.2%. That's the audit rate. In other words, seldomly do they audit the S Corp, and we know why they audit S Corps. Almost all the audits for S Corps are because you're taking distributions and not paying a small salary. Yeah. So all we do is we say, hey, you know what? You never want to get audited. Don't look like that.
Yeah. Yeah. Have an S Corp, have an LLC, pay yourself a salary, pay some taxes, which it's so funny. Like Manny, who, has been my guy for, my goodness, 25 years. That was the first thing. Okay. New business, S Corp plus an LLC. You're going to pay yourself a salary. I'm like, I'm not even making any money yet. He's like, you got to pay yourself something, right? That's how you just, so automatically by doing this, they're going to save a percentage of that 15.3. So if they were just saying, I don't know if it's complicated. I got to find somebody and get an LLC. And I heard that costs money. The money that they're going to save automatically, whether it went from 15 to 10, right? It's $5,000 in savings, just like that.
In the tax
that's how I'm hearing it.
If I put a Schedule C, which is what you'd file as a sole proprietor, and you'd attach that to your 1040, and I put it side by side with an 1120S, which is the tax form you file for a corporation. I've done this over and over again. Most people think the Schedule C is more difficult.
Yeah.
But it's not apples and oranges. They're pretty much identical. You're reporting your income and your expenses in a balance sheet.
Yes.
And it's really easy. By the way, the IRS doesn't distinguish between them for books and records. They say the formalities are the exact same, because that's another one I hear all the time. Well, my accountant said the formalities in a corporation are higher. It's like, no, it's not. It's identical. It's books and records. You have to maintain your income and your expenses. And if you're doing that, it doesn't matter whether you're a partnership, an S Corp, a C Corp, a nonprofit, a sole proprietorship or whatever, you have to keep track of those things, period. It doesn't matter. It doesn't say here's the standard if it's an S Corp and here's the standard if it's not.
Yeah.
Now, from a tax standpoint, once you're an S Corp, you just have to take a reasonable salary, and the profit is no longer subject to self-employment tax.
Bingo.
If you are a sole proprietor,
Okay, everybody, that is your tax tip. And you need to be in the right entity so that you can take advantage and make more money. Today we're having a class, and I'm on my way to it. I'll be a little late. It is agency, and it's do you work for your client? Well, prove it. It's a great class by Jimmy. And Friday we are having our national speaker who usually Zooms in. Her name is Sheila. She goes around the country with her tax strategy 1031 tax exchange. Another great way to, which is what he's talking about if you're a real estate agent, and what Tom Ferry always says, buy real estate. Anyway, I love you all. We will see you on Wednesday, and you all have a wonderful, wonderful day, and go Knights.